the problem with high yielding stocks, chasing dividend yield as a dividend investor. Let's get right into it. Alright, so I'm a dividend investor. It's my preferred investing style. And right here, I have a chart that shows the S&P 500 versus the S&P 500 Dividend Aristocrats Index. Now, as you can see by the data going back to 2005, the volatility was actually lower in the dividend portfolio. The total returns was also higher, obviously accounting for dividends. And also you would have enjoyed a nice income stream if you would have had a dividend focused portfolio. However, there is one problem to dividend investing, and that's when investors get caught up in chasing high yield. Now, chasing high yield is basically just buying stocks with a really high dividend yield and then expecting a large amount of cash flow to then expect really great returns. But that's not exactly how it works. Now, with this video, I kind of want to take a look at the dividend history of 3 certain stocks, as well as the share price appreciation, and see just how well they actually performed, even though they have a really high dividend yield. All right, so let's get right into it with stock number 1, Altria Group. Now, Altria has a dividend yield currently right now of over 8%. It's one of the higher dividend yielding companies right now in the S&P 500, but let's take a deeper look on why this stock is yielding over 8%. So let's start with the dividend history. Now, Altria actually has a really good track record with 51 consecutive years of dividend payments and increases, and they also have a pretty solid growth rate over the past 5 years. They've increased their dividends at about 9.4%. But I will say their dividend growth did slow down over the past year. They only grew it by 3.6%, which is actually understandable with the current market that we're in, but that is a slowdown in the growth rate that investors should be paying attention to. But all in all, these numbers are actually pretty solid. And if you were to invest in a company by just looking at this dividend info, I mean, this would look like a pretty good company, right? Well, let's take a look at the share price appreciation. I have the 5-year chart for Altria Group right here, and as you can see, it's not done too well. Over the past 5 years, we've seen lower highs and lower lows starting pretty much since 2017. And if we take a look at the total return performance, we can also see that over the past 5 years, we've had a negative return on this stock, and it has also trailed the S&P 500 both in the 5-year and in the 10-year. And not to mention the types of returns that you missed out on if you would have just invested in the S&P 500. Now, this could be due to the fact of a declining business model. Now, current smoking has declined from 20% and nearly 21% in 2005 to just 14% in 2019. And you can actually see that in the revenues as well. Since 2015 all the way to 2019, Altria's revenues haven't really done much, growing at about 1% per year. So as you can see, you can't just invest in a company because of its dividend statistics. You actually have to look into a few other things, or else you might end up holding a stock for 5 years and have a negative total return. Let's take a look at another example with Exxon Mobil. Currently right now, the stock is yielding 7.23%. That's a really high dividend yield. Again, one of the top yielders in the S&P 500. And if we take a look at the dividend growth history, it's actually not too bad. They've been growing their dividends for 38 consecutive years. However, their growth rate is pretty bad at just under 4% over the past 5 years. And over the past year, it slowed down to less than 2%, which honestly is not good at all because of inflation. You want to at least have your dividend stocks grow their dividend by more than inflation. A 1.4% dividend increase. Again, it's not the ideal conditions for companies to be increasing dividends, but that's still very little nonetheless. Now let's take a look at price appreciation. And similar to Altria, Exxon Mobil's price appreciation hasn't been doing too well. It's actually been pretty flat over the past 5 years up until 2019. And then in 2020, the stock went under a lot of pressure. And if we take a look at the price performance, we have a similar story here with the 5-year total return being negative and absolutely lagging the S&P 500. And as a matter of fact, the 10-year total return on this stock is also negative. And you can make the same declining business model argument for Exxon. As we continue to move more towards electric energy and renewable energy, Exxon Mobil's business is oil, and that's definitely putting a lot of pressure on the stock. Now, one last stock I want to mention here is a stock that I had to mention in this video just because I own this stock, and that's AT&T. They're currently yielding over 7%. And again, if we take a look at their dividend growth history, it's actually not too bad. They have been growing their dividends for 36 consecutive years. However, the growth rate on this stock is even worse than Exxon Mobil, with their 5-year growth rate being just at 2% and their past year's growth rate at 1.46, again below inflation and not a growth rate that you want to have when investing in dividend companies. Now, if we take a look at share price appreciation, the stock has been absolutely under a lot of pressure up until 2019, where the stock actually picked up some momentum due to activist investors trying to change the business, but it didn't really last long as the stock is back down to the under 30 level. Now, if we take a look at the price performance, at least with this stock, the 10-year and the 5-year total returns is positive, but don't let that fool you. It's still severely underperformed the S&P 500. And you can make the argument for AT&T that will management be able to turn this company around? Will they be able to adapt their business model and become a strong business like they once were? Okay, so after taking all that in, I know I sounded like I was bashing on these 3 stocks, but honestly, I do believe that these types of stocks like Altria, AT&T, Exxon Mobil can fit in a portfolio, and it's perfectly fine to have a bullish thesis on any of these stocks as like a value or recovery play. They do definitely play a role in a portfolio, and you shouldn't just ignore them completely. Now, obviously everyone's situation is different, and if you solely care about dividend cash flow, for example, if you are in retirement and you're relying on dividends as your main source of income, then yes, high yield is important and maybe these stocks are right for you. But from the perspective of someone that is younger and has a longer time horizon, these stocks are going to ultimately do more harm than good for you over the long term. And as a matter of fact, for me, a big focus this year is going to be to rebalance my portfolio to a more dividend-focused portfolio and not care so much about yield. My portfolio right now is about 60-40, with 60% of the stocks having a higher 3-year dividend growth rate than the S&P 500, and the other 40% having either a higher yield or just a slower growth rate. But I do want to aim for this year a 75 to 25% split, or even an 80-20% split between high dividend growth and dividend yield. Now, I did set up some parameters here for new stocks that I'll be buying in the future, and as well also to determine if I'm going to keep or sell some of the current stocks that I have. Now, these parameters aren't set in stone, but I think it's a good guide or benchmark to get started in moving my portfolio to a more dividend growth oriented portfolio. Now, again, I do want to say that everybody's investing style is different, and I do think ultimately the best way to invest in the markets is to invest in a way that you feel comfortable with and hopefully over the long term. But yeah, that's pretty much it. That's the video. Hopefully it was helpful, and thank you so much for watching.